Our next guest says it hasn't been the U.S. debt ceiling or even U.S. economic data that is sending stocks lower. He says the market turmoil is a result of the debt crisis over in Europe. With me right now is Michael Aronstein. He's CEO of Marketfield Asset Management, where he oversees more than $1 billion. By the way, his Marketfield fund beating 91% of its peers last year. So just one of the many reasons why we like to talk to you. What do you make, first of all, of what we're seeing, the selling around the globe? It does feel, Barton Biggs saying, it feels like panic selling at this point.
It's getting to the edge of panic, but I don't think people have discerned the reason for it, the real fundamental driving force, which I do believe is the breakdown of the kind of post-World War II system of governance and government action within the EU.
So you think it really is all of Europe at this point? What about the concerns, Mike, about what's going on here in the United States? We got those revised GDP numbers. That was a bit of a shocker. The labor market continues to struggle. We'll get another read tomorrow. The housing market. It's not the U.S. here?
No, we do have issues, but they're not the same issues that are at the acute phase in Europe. I mean, our government voluntarily undertook to debate a debt ceiling in the last couple of weeks. It wasn't pretty, but
it was a good thing in your view, and there was structure to it.
It's much better than going the way of Greece, which just borrowed everything it could get its hands on for years and years, and then came with its palms outstretched saying, oh, by the way, we owe $500 billion and we don't have it.
You and I were talking a bunch in the break, and we were talking with Adam. I mean, it's really a mess over in Europe. There's a lot of different players. They can't seem to figure this one out. I mean, if that's the case, then what's the drag on the global markets? I mean, is this a drag that goes on for, what, another year, another several years? I mean, how do we get out of it?
Well, the acute phase is going to last until the ECB is forced to undertake QE3. We are going to have QE3. It's going to come from Europe.
This is going to be a European forum.
Yeah, and if they were even slightly competent, it would start tomorrow, but they're not. So it's going to take a little bit of time. And the markets are going to hold everybody's feet to the fire until the ECB capitulates. They are going to be like a margin investor who's long and the phone is ringing. And however much they protest that they're not going to be driven to do anything, they are.
Hey, Michael, I think you got plenty of company in thinking that there will be a QE3, but my question is, QE1, QE2 obviously didn't work. Look at the markets where we are today. There's evidence of that. So why throw more good money after bad?
Well, I'm talking about a QE3 in Europe, not in the United States.
But same difference. I mean, we're all in this together.
It's not the same difference, really, because what we're going to have with European QE3 is well, if they do it properly, they will stop the complete breakdown of their sovereign debt markets, which, if it continues, will destroy their banking system. And it won't take very long before they do that. They have a real funding crisis over there right now. U.S. money market funds, which are big participants in European bank short-term funding, are pulling back everything right now, as they should be. And the ECB, along with the banking regulators, basically has forced the European banks into holding a tremendous proportion of sovereign debt on their balance sheets. And that's been the effect of the aftermath from a regulatory standpoint of 2008. And of course, they've chased them right into the most dangerous part of the global markets.
So what do you make then of what the ECB, what we got from Jean-Claude Trichet today? He made a statement. He said the downside risks may have intensified. He says they relate to the ongoing tensions in some segments of the euro area financial markets, as well as to global developments, and the potential for these pressures to spill over into the euro area real economy. So he says this. I mean, do you feel like the ECB is kind of getting us ready for some kind of action here?
They ought to be, and they ought to do it tomorrow morning.
They ought to. I mean, why didn't we get maybe something more today?
They're not competent. They are woefully lacking in competence. They just tightened 4 weeks ago.
I know.
I mean, that's the second most idiotic official response I've seen. The first being their tightening in 2008.
I saw you raise your eyebrows. I mean, are we making too much out of the global selling? I mean, sometimes we need to have a voice of reason in all of this. We've seen a lot of panics before. I mean, how would you put this one among some of the other selling that we've seen over the last decade or so?
Well, I think you have real problems in the capital markets outside the United States. A lot of money has gone, and we've talked about this ad infinitum, into EM and other non-dollar markets. And the EM has a problem with intentional monetary tightening, which they've done in response to the inflationary pressures that have emerged. And that's very destructive at this stage because those economies have become more leveraged in the consumer and real estate sectors. And which is
what we're seeing in China,
right,
playing out big time.
Exactly. And then the EU is seeing tightening from the markets, spreads are starting to widen dramatically. Sovereigns are really coming out, and there's a lot of pressure being put on by market action. It's not intentional, although, again, the ECB has just finished tightening 4 weeks ago, which really was one of, that will go down in
yeah. Oops, big time.
Yeah.
Hey, so let me ask you, Mike. Do you think then, because of the selling we're seeing, I know you say, the guys over in Europe, they just don't have it together. Could we, though, potentially tomorrow, early next week, see the ECB do something to start correcting things? Because they have to, out of necessity at this point.
I would think so. I have no idea what their pain threshold is, but they're going to reach it.
Yeah.
Whether it's today or tomorrow or Monday or, when they all come back from the Côte d'Azur.
But they've got to do something. What have you been doing with all of this selling? It's not just today, obviously a lot today, but go back to July 22nd. We've seen pretty much a real market correction here on the S&P and the Dow. If you go back to those April highs, you've done really well. Have you been aggressively buying here?
We've done some buying. We've covered some shorts, too early, obviously, and added some others. But yeah, I think we're looking at this as an opportunity to probably buy some things that became extended that have come back into buying zones. And again, we're reasonably constructive about the United States versus the rest of the world. And we'll see. The proof is going to be in the pudding.
Is it a less dirty shirt, as I keep hearing over and over and over again? Is it that, or do that you actually like the U.S.?
We really have a functional economic system despite our political problems at the moment. We have a mechanism that underlies the markets that's really generative, and we have the capability to grow and generate a great deal of wealth. The European periphery, given the current state, does not.
So you mentioned that you guys have been somewhat, adding to some positions. Can you give me an idea of where you guys have been buying, what you like at this point, or? We've
added some in retail. We've added some kind of in the direction of the U.S. consumer. We've covered a few shorts in emerging markets.
Do you feel the need to go defensive at all? We're seeing the defensive sectors also get hit here.
Yeah, we bought a couple of companies that have been traditionally defensive, but I will say really, when you look fundamentally, the most defensive index in the U.S. markets is the NASDAQ 100. If you look at the Qs, look at the names that dominate that list. It's Apple. It's Google, it's Intel, it's Qualcomm, all these companies that have pristine balance sheets. They generate tons of cash.
Right.
They have no problem with debt or leverage, and that's almost become the defensive part of the U.S. market. And the fact, if you look at the relative performance of the NASDAQ here versus the emerging markets, it's quite remarkable how well it's done over the past couple of days.
God, that's some interesting perspective. Mike, we got to run. Thank you so much.